Good morning, everyone, and welcome back to the channel. Today, we're covering something absolutely essential for Australian retirees and those planning their retirement. We're talking about the Australia Age Pension for 2026, specifically focusing on single payment rates and the eligibility rules that determine whether you qualify for this vital income support. If you're currently receiving the age pension, approaching retirement age, or planning ahead for your financial future, this video contains information that could directly impact your fortnightly income and your retirement lifestyle. Now, I know that navigating Centrelink and Services Australia can feel incredibly complex, especially when you're trying to understand all the different rules, thresholds, and payment calculations. But here's the good news. I'm going to walk you through everything step by step in plain English, breaking down exactly what the payment rates are for single pensioners in 2026, what the eligibility requirements are, how the income and asset tests work, and what changes you need to be aware of. By the end of this video, you'll have a complete understanding of where you stand with the age pension system. Before we dive into the numbers, if you find this kind of content helpful, please hit that subscribe button and click the notification bell. We regularly cover updates on the age pension, superannuation, retirement planning, and all things related to financial security for older Australians. Your support really helps us continue providing this free information to the community. Let's start with the fundamental question. What exactly is the age pension? The age pension is a government payment designed to provide income support to older Australians who have reached pension age and meet certain residency, income, and asset requirements. It's means tested, which means the amount you receive depends on your financial circumstances, and it's indexed twice a year to keep pace with increases in the cost of living. This isn't a payment you've directly paid into like superannuation. Rather, it's funded through general taxation and represents Australia's social safety net for retirees. The age pension serves as either the primary income source for many retirees or as a valuable supplement to their superannuation and other retirement savings. Understanding how it works is crucial because even if you have some savings or part-time income, you might still be eligible for at least a part pension, which also gives you access to incredibly valuable concession cards that reduce your costs for healthcare, utilities, transport, and other essential services. So let's talk about the single payment rates for 2026. The age pension is indexed twice a year on the 20th of March and the 20th of September. These indexation dates are when your payment amount increases to reflect changes in the cost of living. The indexation calculation uses three different measures: the Consumer Price Index, the Pensioner and Beneficiary Living Cost Index, and Male Total Average Weekly Earnings. Whichever measure produces the highest increase is the one that gets applied to your pension. This triple indexation method is actually quite generous compared to many other countries and ensures your pension maintains its purchasing power over time. For March 2026, based on current economic projections and historical indexation patterns, single-age pensioners can expect a maximum base rate of approximately $1,116.30 per fortnight. Now, this is just the base component of your total pension payment. On top of this base rate, you'll also receive additional supplements that form part of your regular fortnightly payment. The pension supplement is paid to help cover household expenses like telephone bills, internet costs, and other essential utilities. For single pensioners in 2026, this supplement is projected to be around $82 per fortnight. Then there's the energy supplement, which is a smaller amount designed specifically to help with electricity and gas costs. This is estimated to be approximately $14.10 per fortnight for singles. When you add all these components together, a single age pensioner receiving the maximum rate could expect a total fortnightly payment of around $1,212.40 in March 2026. Over a full year, that works out to approximately $31,522 in pension income. Now, these figures will increase again in September 2026 when the next indexation occurs, with the exact amount depending on inflation and wage growth in the months leading up to that adjustment. The work bonus only applies to employment income, not to investment income, rental income, or other sources. This policy is designed to encourage older Australians to remain in the workforce if they're able and willing, which benefits both the individual through additional income and society through their continued participation and experience. Now let's talk about deemed income, because this is a concept that confuses many people but significantly affects your income test assessment. If you have financial investments like savings accounts, term deposits, shares, or managed funds, Services Australia doesn't look at the actual income these investments produce. Instead, they apply deeming rates, which are standardized assumed rates of return. As of 2026, the deeming rates are expected to be around 0.25% on the first $69,400 of your financial assets and 2.25% on amounts above that threshold. Why does the government use deeming? Because actual investment returns can vary wildly from person to person and year to year. Deeming creates a level playing field and prevents people from manipulating their investments to show artificially low income. However, it also means that if your actual returns are lower than the deeming rates, perhaps because you keep everything in low interest savings accounts, you're still assessed as if you're earning the deemed amount. Conversely, if your investments are performing really well, you might actually be earning more than the deemed amount, but only assessed on the deemed income, which can work in your favor. Moving on to the assets test, which for many singles, especially homeowners with modest savings, is actually the test that determines their pension rather than the income test. The assets test looks at the total value of your assets, not just financial investments, but also things like vehicles, caravans, boats, collections, and investment properties. Your family home is exempt if you own it and live in it, which is a significant advantage for homeowners in the pension system. For single homeowners in 2026, the asset test free area is projected to be around $314,000. If your assessable assets are below this amount, the assets test doesn't affect your pension and you'd receive the maximum rate, subject to the income test. Once your assets exceed this threshold, your pension reduces by $3 per fortnight for every $1,000 of assets over the limit. For single homeowners, the pension completely phases out once assets reach approximately $678,000. For single non-homeowners, the thresholds are significantly higher to recognize that you don't have the benefit of a mortgage-free home. The asset test-free area is around $556,000, with the pension cutting out at approximately $920,000 in assessable assets. This higher threshold acknowledges that non-homeowners need additional assets to fund their accommodation costs in retirement. What counts as assessable assets? Pretty much everything you own except your family home and certain personal effects. Your car is assessed at its market value, though usually only one vehicle is counted at full value. If you have a caravan or boat, these are assessable. Investment properties are included at their market value minus any outstanding loans. Superannuation counts as an asset once you've reached age pension age, even if you haven't accessed it yet. Household contents and personal effects are generally not assessed unless they're particularly valuable or you have significant collections. One important strategy some people use is gifting or spending down assets before applying for the pension. However, there are strict rules around this. You can gift up to $10,000 per financial year and $30,000 over 5 years without it affecting your assessment. Anything you gift beyond these amounts is still counted as an assessable asset for 5 years from the date of the gift. This deprivation rule exists to prevent people from simply giving away their wealth to qualify for the pension, then getting it back later. Let's talk about some common scenarios for singles to illustrate how this all works in practice. Imagine you're a single homeowner with $300,000 in superannuation and savings, earning $20,000 per year from a part-time job. Your assets are below the homeowner threshold, so the assets test doesn't reduce your pension. Your employment income of around $385 per fortnight is mostly covered by the work bonus, and your deemed income from your financial assets adds a small amount. In this scenario, you'd likely receive a full or near full age pension, plus the ability to keep most of your employment income. Or consider a single non-homeowner with $500,000 in superannuation and no other income. You're below the non-homeowner assets test-free area, so you'd receive the maximum pension. The deemed income from your assets would be assessed but would still fall within acceptable limits under the income test. This scenario shows how the higher thresholds for non-homeowners help compensate for rental costs. Now let's discuss a single homeowner with $700,000 in assets and no other income. Your assets exceed the cutoff point for the pension, so you wouldn't be eligible for any age pension payment. However, you might want to consider your spending patterns, as if your assets reduce over time through funding your retirement lifestyle, you could become eligible later. Some people in this situation benefit from financial advice about optimal drawdown strategies. Beyond the fortnightly payment itself, receiving the age pension, even a part pension, provides access to the pensioner concession card. This card is genuinely valuable and can save you thousands of dollars per year through bulk billing at medical appointments, cheaper prescription medications through the pharmaceutical benefit scheme, discounts on utilities, council rates, public transport, and various other concessions. In some cases, the value of the concessions can rival the pension payment itself, making it worthwhile to structure your affairs to maintain eligibility even for a small part pension. For the September 2026 indexation, we can expect another increase to all these payment rates and thresholds. While the exact figures won't be known until closer to the date, historical patterns suggest increases typically range between 1 and 3%, though this varies with economic conditions. High inflation periods produce larger increases, while stable economic conditions result in more modest adjustments. The important thing is that these increases happen automatically for existing pensioners. You don't need to reapply or take any action. If you're planning to apply for the age pension in 2026, preparation is absolutely key. The application process requires extensive documentation, including proof of identity, residency history, details of all your income sources, valuations of all your assets, bank statements, and more. Services Australia recommends lodging your claim around 3 months before you reach pension age to allow time for processing. You can start your claim up to 13 weeks before your qualifying age birthday. The actual application is completed through your MyGov account linked to Services Australia, or you can get assistance from Services Australia staff at a service center or by phone. The online process guides you through each section and tells you what documents you need to upload. Common documents include birth certificate or passport, proof of Australian residency, bank statements for the last 12 months, superannuation statements, property valuations, vehicle registration papers, and details of any shares or investments. One area where people often make mistakes is in reporting their income and assets accurately. Being honest and thorough in your application is absolutely essential. Services Australia has sophisticated data matching capabilities and receives information directly from banks, the Australian Taxation Office, and other government agencies. Deliberately understating your assets or income is welfare fraud and can result in serious penalties, including having to repay overpaid amounts, financial penalties, and potentially criminal charges. It's simply not worth the risk. If your circumstances change after you start receiving the pension, you have obligations to notify Services Australia within 14 days. This includes changes like receiving an inheritance, selling property, starting employment, or any other change to your income or assets. Many changes can be reported easily through your MyGov account, and keeping Services Australia informed helps prevent overpayments that you'd later need to repay. For singles living in retirement villages or aged care facilities, there are some special considerations in how your accommodation is assessed. Generally, if you pay an entry contribution or accommodation bond for aged care, this amount is exempt from the assets test while you're a resident, though your former home may become assessable unless it's occupied by certain protected persons like your dependent child. These rules are quite complex, and if you're moving into aged care, it's worth getting specific advice about how it affects your pension. Looking at the bigger picture for 2026 and beyond, the age pension system in Australia is generally regarded as sustainable and secure. While there are ongoing policy debates about the appropriate level of support and how means testing should work, major parties have generally supported maintaining the system. The indexation mechanism ensures the pension keeps pace with living costs, and regular reviews help the system adapt to changing demographics and economic conditions. For singles planning their retirement, understanding how the age pension fits into your overall retirement income strategy is crucial. For some people, the pension will be their primary income source. supplemented by modest superannuation drawdowns. For others, it might be a useful supplement to more substantial superannuation or investment income. And for those with significant assets, planning around the asset test thresholds can help determine optimal retirement timing and spending patterns. One final important point: if you're declined for the age pension or you disagree with the assessment of your payment rate, you have review rights. You can request an internal review by Services Australia, and if you're still not satisfied, you can appeal to the Administrative Appeals Tribunal. Many successful appeals happen each year where initial decisions are overturned, so if you genuinely believe there's been an error, it's worth pursuing. Thank you so much for watching this comprehensive guide to the Australia Age Pension for Singles in 2026. I hope this has given you complete clarity on the payment rates, eligibility requirements, and how the means testing works. The age pension is a fundamental part of retirement security for millions of Australians, and understanding your entitlements means you can plan confidently for your retirement years. If you found this helpful, please give it a thumbs up, share it with friends or family who might benefit, and subscribe to the channel for regular updates on age pension changes, superannuation, and retirement planning. Take care, and I'll see you in the next video.